And let me just hand it over to Alessandro Rebucci, who is going to present to us estimating macroeconomic models of financial crisis and endogenous regime switching approach. And this is joint work with Gianluca Benigno, Andrew Foerster, and Christopher Otrok. All right, the floor is yours.
Can you see my slides? Can you hear me?
Yes, we can hear you and we can see your slides.
Thank you, Martin, for the kind introduction, and good morning, everybody. This, as Martin mentioned, is with Gianluca, Andrew, Chris, and we're going to be talking about an approach to estimating model of financial crisis as endogenous regime switching. So after the global financial crisis, there was a renewed interest in the causes, consequences, and remedies of financial crisis. And in this context, model with occasionally binding financial friction, and in particular, collateral constraints, have proven helpful and useful in thinking about these episodes of financial dislocation with important macroeconomic consequences. On the other hand, structural estimation in general of model is important for inference, for counterfactual analysis, and forecasting. But in this environment is particularly challenging because we can solve these models with global solution methods, which are computationally intensive and time-consuming. So the main contribution of this paper is to propose an approach to represent an occasionally binding collateral constraint as an endogenous regime switching process. We then propose a perturbation method for the solution of such a model. And this method that we document in the paper is fast, relatively accurate, and can in principle be scaled up to larger scale model, like, for example, those used in central banks. And then we apply the framework to Mexico history of business cycles and financial crises since the beginning of the 80s. In the interest of time, I'm jump straight into my presentation. I will focus primarily on this endogenous switching representation of the collateral constraint, the solution, its properties, and how we evaluate the likely function, and then I will present selected empirical results. So the model that we use is a workhorse medium-scale DSG. In particular, preferences and technologies are pretty much the same, are actually exactly the same as in Mendoza 2010, which was one of the first of these models applied to business cycle and crisis analysis in emerging markets. We consider a broader set of shocks in the spirits of Smets and Wouters, and in particular, we consider the 6 shocks in the estimation exercise of Garcia, Chico, et al., also Mexico data, another AR paper in 2010, in order to encompass those 3 shocks typically used in the occasionally binding literature, but also other that have been considered in the literature. So the distinctive feature of the economy here is that we switch between the constrained regime, where the collateral constraint bind exactly, and unconstrained regime, which is like the corresponding business cycle model without the financial friction. The key difference relative to the traditional specification is that the switch, rather than for given value of the endogenous and exogenous state, by being triggered by a unique level of leverage, for example, it happens for a range of leverages in a stochastic manner, because even if the constraint is binding exactly, we still need to draw from a probability distribution the regime switch, where this probability is endogenous and depends on the distance of the economy from the collateral constraint when we are in the unconstrained regime, and on the multiplier when we are in the constrained regime. So these are preferences and budget constraints from the Mendoza model. There is nothing new. These are the shocks. We have technology, temporary technology shocks, term of trade shock, preferences, and expenditure shock that capture both fiscal policy and shifting in foreign demand, exogenous shifting in foreign demand, and then a process for the interest rate, which has a persistent component capturing the slow movements in the world rate or the US base rate, and then a temporary component that is non-persistent and is capturing the exogenous portion of the interest rate premium on foreign rates. Here is the borrowing constraint in the binding regime is exactly as in Mendoza 2020. So we have the total borrowing for consumption smoothing or for working capital purposes has to be equal to a fraction kappa of the collateral, where a capital evaluated time t is serving as collateral. In the non-binding regime, borrowing is unconstrained, and we will characterize that with the difference between actual borrowing and the value of the constraint. So we bring the collateral on the left-hand side, and that's going to be denoted B star, and as a key variable in the model, we call it the borrowing cushion. We switch between regime as a function of these two logistic distribution. We switch from the non-binding to the binding regime as a function of the distance to the constrained state, and we switch back from the binding to the non-binding as a function of the value of the multiplier on the collateral constraint. These are not proven to be sufficient statistics. So indeed here there is an element of this is the shortcut that we have to take to get here. One could perhaps try to devise sufficient statistics, but these are the variables that are typically driving dynamics in these class of models. These are the policy function for capital for the endogenous state, for capital and the bond holding rules in the two states, and you see the nonlinearities captured by the second order approximations. A couple of other important remarks are that first, there is growing evidence at the micro level that collateral constraint, and in particular covenants in lending, borrowing and lending interaction, are not imposed exactly. They're typically renegotiated when firm and household approach their limits. The renegotiation or smoothing seems to be prevailing microdata. The constraint, as we specified it, is not microfunded, strictly speaking, as much of the literature, but certainly to a more extensive degree than the traditional model in the literature. However, it could be in principle, and we discuss it in the paper, and here there are a couple of references how one could get to an endogenous switching characterization of the financial friction. So in terms of solution method, the key is to reformulate the typical slackness condition as a regime switching slackness condition, which map regimes into traditional parameter switching, and then we apply the partition principle that Andrew proposed in a paper with his co-authors for exogenous switching regimes. And let me go straight to that. So this is this expression here, this equation here in the middle of the slide is the regime switching slackness condition. Is a way to guarantee that given the switching parameters, which the partition principle wants to separate those that affect the level, the steady state of the economy, and the dynamics. In our case, which is simpler, we have only one switching parameter, which is the regime indicator. Here we formulate it more generally so that it can be applied to other settings. But this condition over here is such that when we are in a non-binding regime, it implies that the multiplier is equal to 0. When we are in the binding regime, it implies that the borrowing cushion must be 0, and therefore the constraint holding with equality, while at the same time being continuously differentiable and thus allowing us to use perturbation methods in the solution. We need an approximation point. There is debate on what is the best way to do it. I'll get to that. Let me step back. I made a false steps. So a key property of the solution is that we show, and we have an analytical statement or proposition, that we need to go at least second order to capture the impact of endogenous switching on the decision rule. So to get the kind of curvature that I documented earlier in the chart, we need at least a second order approximation. The solution is fast and accurate. In particular, when we compare it to a global method for the same model, we have Euler equation error that are between 1 and 3 times larger than in the global method, but we have a computing time that is about three order of magnitude faster, which is what makes, and also in absolute level, these errors are absolutely comparable to what is regarded as the standard in the exogenous regime switching literature. But we have an efficiency gain of 3 order of magnitude, which is what makes estimation feasible. In terms of estimation, we don't innovate, we borrow from the literature. And another important point here is how we evaluate the likelihood. We use the Kalman filter with sigma points. We have taken a lot of heat for this choice, but we do document in the paper that the model can fit the data well with relatively small shocks, that is to say shocks within the 2 standard deviation errors, and with very limited departure from normality. So let me move into some results. How much time do I have left?
You have about 5 to 7 minutes.
Okay, so observable output consumption, investment growth, the country interest rate as in Uribe U, the current account and import prices, a constraint on the measurement errors, very loose priors on the key parameters, posterior that are very tight, so we don't see identification problems. So this is the sense in which the model fit the data and fit the data well, and the Kalman filter with sigma point does a good job. We fit the model not only in the white arrow as a regular cycle, but also during the period of crisis identified in the model. And as you can see, for one particular shock, so this is one series and one shocks, but in the paper you've got documentation for other observable and for the other shocks. We are well within the 2 standard deviation, including during the crisis period. So here there is only a case at the beginning of the sample where we depart. And showing you the most cleanly estimated shock and the one that depart the most from normality, you can clearly see the TFP shock pass all the normality test. In the case of the expenditure, we have departure from symmetry and skewness, mostly from symmetry rather than skewness, but you can see that departure is not dramatic. Second moment, we capture all the second moment of a typical model of an emerging market business cycle, variance decomposition, key difference relative to the typical model in the literature that no shocks dominates, but different shocks are important for different variables. You can see here, for example, the interest rate shock is really important for the trade balance and for the borrowing cushion and for the interest rate. But for other, in particular for the macro variable, we have that all shocks play some roles in a way that is discussed in the paper and interpreted. So this is perhaps our most important results in the paper. The black solid line is the smoothed probability of being in the banding regime, taking into account sample and regime uncertainty. And we define a crisis period, this vertical dashed line, as this probability above 90%. Could be 95%, 97.5%, 99%. There would be very little sensitivity to where we draw this bar, changing this confidence level. And as you can see, we identify crisis episodes which are significantly more persistent relative to the red bar, which are essentially the same notion of conditional probability, adding the 2 typical ad hoc restrictions in the sudden stop literature that the current account reversal and the output drop need to be larger by a certain amount. So essentially, with those criteria that are used to achieve quantitative performance, quantitative matching, what they pick up is the peak of the crisis. But if we look at the gray line, which is the Rayner-Rogoff crisis tally index, we can see that crisis periods are much more persistent, consistent with a bunch of empirical evidence out there that we refer to in the paper, than the typical crisis episode identified in the occasionally binding models, like much of the work that we've done with Gianluca and other co-authors, Chris and other co-authors from a normative perspective. So the model does generate more persistence than the typical specification. And it does throw this idea that even if you're close to the constraint, you don't necessarily switch to the binding immediately. The model does not mistake recession for crisis. The gray areas here are recession as dated by the OECD. Here are simulation of crisis episode of the same length as the one that we estimate from the model. So there are 10,000 rows, and then we select those episodes that last 8 quarters, like in the data. We take the average. This is the observable, and overlay to that is the average of the data, the observable, in the 3 crisis period. And as you can see, at the quarterly frequency, we do remarkably well, both in terms of magnitude and persistence, not for all variable, but remarkably well. By comparison, if we compare data, our model, and the same simulation from a traditional model, you can see the traditional model, the blue thin line, gets the magnitude of the dislocation, right? The trough over here are actually even below data if we take average of the 3 crises rather than just the tequila. However, they are completely off in terms of persistence, while our specification get much closer to the data, perhaps overstating persistence in the case of investment. Then we also do an historical decomposition of this estimated crisis episode. We have 3. I do not have time to take you through these episodes. Same message, which is the least interesting here, perhaps, that different shocks characterize not only different crises, but also different phases. What is interesting is the narrative that came out from this episode is quite different than the narrative that you would get from the calibrated model. For example, in the case of the tequila crisis, I would have personally expected to find mostly driven by interest rate shocks. But here we see the importance of the preference shock. And then by digging into the history of that event, it turns out that political developments were quite important throughout 1994 in the run-up to the crisis. When it comes to the debt crisis, for example, there is the most important shocks before the crisis is, yes, we know the story about the interest rate, but here come the interest rate capturing the role of oil prices in Mexico economy, which are very important. And for the global financial crisis, again, we have a mixture of shocks, again, in terms of trade important, consistent with more recent work by Martin Uribe, Stephanie, and Andre Fernandez on that. So let me conclude. We propose a new approach to specify and solve model with occasionally binding constraint, which is suitable for estimation. We apply it to Mexico. We find that the model fits the data well with its mechanism rather than large or skewed shocks. This model identified 3 crisis episodes, which are of a persistence that is comparable to the data, much more comparable than traditional model. And we have historical decomposition in this episode that allow us to identify a broader set of shocks than what is typically concluded from traditional model. Thank you.
All right. Thank you, Alessandro. And without much delay, let me turn it over to Yasuo Hirose as the discussant.
Okay. First of all, thank you, organizers, for providing me the opportunities for discussing this very interesting paper. I'm Yasuo Hirose from Keio University in Tokyo. Okay. So here's a summary of what the authors do in the paper. Okay, so the authors propose a novel specification of an occasional binding constraint by introducing an endogenous regime switching between the unconstrained and constrained states. Okay, in a standard regime switching model, okay, switching probabilities are set exogenously, okay, as a parameters. Okay, but in this paper, okay, the switching probabilities are determined by variables, okay, that characterize the constraint. Okay? So to solve such a model, the authors developed a solution method, okay, using a higher order perturbation approach. Okay? And then they estimate a small open real business cycle model with an occasional binding constraint, okay, to fit the model to the Mexico business cycles and the financial crisis episodes. Okay? In general, it is very time-consuming to estimate the model in a fully nonlinear setting, but thanks to this specification and their solution method, okay, the authors conduct nonlinear estimation very efficiently. This is very good. Okay? And the estimation results show that the model can explain three crisis episodes very well, okay, in terms of varying duration and severity without relying on large or skewed shocks. Okay? I like these results very much. Okay? Without regime switching features, the huge shocks were required to replicate the crisis episode. But in this model, okay, endogenous regime switching amplifies the propagation of shocks so that no huge shocks are required to replicate the crisis dynamics. This is very interesting. Okay? So what might be controversial in the paper would be whether the proposed specification and the solution method well approximates the occasionally binding constraint. Okay? So in the traditional inequality specification, okay, it can be written as this kind of inequality constraint, okay, like this. Okay? The left-hand side is the borrowing amount, and the right-hand side is the borrowing limit. Okay? But in their endogenous regime switching specification, okay, the authors first defined the BT star as a difference between okay, between the borrowing amount and the borrowing limit. Okay? So in the traditional inequality specification, okay, this BT star must be zero. Okay? The BT star equal to zero means that the constraint is binding, okay? Because this constraint is held with equality, okay? And in the endogenous regime switching specification, transition probability from the non-binding to the binding regime can be specified by this logistic function. Okay? Under this specification, okay, as BT decreases, BT star decreases, the transition probability increases gradually, okay, around BT star equal to zero. Okay? This gamma zero is a parameter, okay, that controls the slope of the logistic function. Okay? As gamma zero increases, okay, the slope, okay, is getting steeper. Okay? And as a limiting case, okay, when the gamma zero goes to infinity, this specification will be the same as the traditional inequality specification, because the switching probability to the binding regime would be 1, okay, when the BT star is 0. Okay. So other than this limiting case, okay, a possible criticism to the endogenous regime switching specification here is that even if BT star is less than or equal to 0, okay, the economy could still be in the non-binding regime with some probability. Okay? It must be binding in the traditional inequality specification. Okay? However, the authors nicely defend their specification by referring to the microevidence on lending and borrowing behaviors at individual, household, firm, and bank level. Okay? For example, they mentioned that the loan conveyancer applies smoothing over time, okay, triggering renegotiation rather than suddenly cutting off borrowers from funding once activated. Okay? And they also argue that, as in practice, collateral constraints bind for a range of leverage ratios, okay, rather than at any particular level, as in the model with inequality constraints. Okay? I like this explanation very much, which are quite convincing to me. Okay? So what about the solution method? Okay? There are several approaches to deal with occasional binding constraints. Okay? The fully nonlinear global solution approach using the projection methods, and the piecewise linear approach where the constraints are imposed but other equilibrium conditions are linearized using an Ockman toolbox. And the higher order perturbation approach. So this paper takes this approach. But more specifically, the authors employed a second order Taylor series approximation around the ergodic mean of each variable. And this table summarizes the pros and cons for each solution method. The fully nonlinear approach can deal with precautionary effects because this is fully nonlinear. But it's very time-consuming to solve such a model. On the other hand, the piecewise linear approach is much faster in terms of computation time, but cannot deal with precautionary effects. The higher order perturbation is good because they can deal with precautionary effects because of the higher order term, and the computational speed is also very fast. So these are very good. However, in a model with regime switching, with occasional binding constraints, policy functions typically exhibit some kinks at the boundary between the binding regime and the non-binding regime. The free nonlinear approach and the piecewise linear approach can give such a kinked policy function. But higher order perturbation cannot. And because of these kinked policy functions, the impulse responses can be very much different between the binding states and non-binding states if the model is solved in a fully nonlinear approach or piecewise linear approach. But higher order perturbation approach can also give the different impulse responses depending on the state of the economy, because this is no longer linear. We have perturbation approach have a higher order terms, so that we can generate a different impulse response in principle. But I'm not sure in this specific case with this endogenous regime switching. So my question here is, can the proposed solution method generate distinct impulse response functions depending on whether the constraint is binding or not? If it can, the proposed solution can be a good substitute for the fully nonlinear approach and the piecewise linear approach. I'd like to see what happened when we compute impulse responses. I have another specific comment. So in section 6.4 in the paper, the authors analyze a model simulated crisis dynamics. But when I read the paper, I was not able to capture how the simulated paths are constructed. The more specifically, my question is, how are the shock series calculated to replicate the crisis episodes of 8 consecutive quarters? The reason why I'm asking this question here is that according to figure 7 of the paper, which shows the sequences of the shocks and the resulting dynamics of the endogenous variable, this is an artificial crisis episode. But when we look at these shock processes, we can see the huge swing in the shocks about the import prices and expenditure and preferences and the persistent interest rate. As if there were some regime switching in the shock processes. However, if the endogenous regime switch worked well, such huge changes in shocks would not be needed. So what's puzzling to me is that in section 5, the estimated model can replicate actual crisis episodes very well without relying on large shocks. But in this exercise, huge shocks are needed. So what's going on here? This is my question. If the authors can pick the sequences of shocks with much less fluctuations, it will be more consistent with the result in section 5. So this is my specific question and comment here. Okay, so that's all. Thank you.
All right, thank you very much. So we can sort of, while we maybe give others a little of a quick chance to sort of write Q&As, maybe I let Alessandro just take over and respond to this very nice discussion.
Thank you, Martin, and thank you, Yasuo, for your very generous and thoughtful discussion. Let me answer a couple of questions that you raised, working backward on the simulation. So what you see in that chart is actually the cumulative of the first difference shock. So that is a sequence of small shocks. So indeed, we also discuss it in the paper. You need to have a cocktail of shocks that can move in a certain way for a persistent period of time to get to these larger persistent dislocation. But these are sequences of small shocks. And here what you see are the level implications. So these are the cumulative. How the simulation is done, we simulate for 10,000 period. We extract from the simulation those consecutive periods in which the smooth probability of being in a binding regime is at least 90%. So we use the same definition of crisis that we use in estimation, and then we back out and we look at the variables and the shocks in level term to see what they look like 5 years before, during the 2 year of the crisis. By definition, is 2 years because we select episode of 8 quarters and the 5 years after the crisis. So the shocks are as small as the one in estimation. Shocks do not have regime switching. It's indeed a relatively straightforward extension, but precisely for what you said, we don't want to allow that because otherwise it becomes difficult to disentangle the two. On your other point on the solution, it is true that these policy functions do not have kink. Now, we all know that all models are wrong. So it's natural because here we want to propose a way to estimate that kind of class of model to look at the comparison, and we do that comparison moment by moment in appendix. What we are trying to say is that, yes, for normative purposes, you need a well-specified contract from which the friction is coming from to do optimal policy. For positive purposes, I think we should be open-mindedly look at the data, and it looks like that both at the micro and the macro level, such a more flexible specification does a good job. We were reporting impulse responses by regimes in earlier version of the draft. They are very different. In this class of models, what really matters is the policy function. So that's why we moved away from that kind of comparison. There are a lot of technical problems. Think about an impulse response in this setting, but if one wants to look at them, we can. We've shown them. They're very different, and they are consistent with intuition. So I take your point that better understanding those simulation is important, and I agree. We are not. We need to go with a very high gamma to get closer, but that's the data tell us that the gamma that is relevant is lower than the 100 that you use. But I also would like to invite you and the rest of the audience to think about the fact that, in light of the fact that all models are wrong, here is an invitation to think about a different specification of the collateral function. Going to make questions. Here we rule out multiple equilibrium by imposing parameter restriction we try to, we have a few parameters we calibrate and we make assumption there which should not give us multiplicity per se. In the simulation, then we use pruning and we get rid of explosive paths. So we have neither existence nor stability or uniqueness guaranteed analytically. So yes, the model is prone to the kind of problem pointed out by Martin and Stephanie, subject to, as I said, avoiding parameter points in the parameter space that we know that would go there. Maybe you should compare the model with one where financial friction are smooth like BGG. Yes, so that's a good point. So comparing to multiple model, we compare to the German Quadrini, which is a smaller model, and we could do more in that direction. I agree. I agree with you. Martin earlier was asking about the choice of the B star and the lambda for the logistic function. Yes, we did robustness at the beginning of this project before committing to this, and it seems to be fairly robust. Adding variable does not make much of a difference, and using other variable does not give similarly plausible results. We are trying to do something more general. I don't think we can get to a sufficient statistic type of analysis here or statement, but we are trying to devise a way in estimation for checking more systematically whether we can rule out other specification with more variable or other variables. I think that's what I have here.
I see.
The expenditure shock mix is in the budget constraint, is a shifter in the budget constraint, is the autonomous component of expenditure, and it can capture fiscal or a foreign exogenous demand. This is coming straight from the Garcia-Chico paper. They use that shocks. That's why we wanted comparability in terms of the set of shocks, because they use same data, Bayesian estimation, just different financial friction.
Right.
I see Janil has a hand up, but hold on, go ahead, Mick.
Presumably you could do this with flow collateral constraints as well, like in your previous papers. It works just as well.
Yeah. As you know, those collateral, that specification, even the occasionally bounding nature, is difficult to sell. So we thought that starting from something that is more acceptable to begin with was a good term of comparison. But yes, that actually would be easier.
Janil, so you have a hand up? Is that still?
Yeah.
Okay.
Yeah, thanks. Two key questions. One is, when Alessandro, you presented that the speed is 2 or 3 times faster or slower, is it double or triple, or is it 100 or 1,000 times?
In 1 second is 800 times faster.
800 to the order of 2 or 3. Okay, got it. And then the other one is, you showed us the smoothed probability of crisis. Do you happen to calculate any one-sided filter probability as well?
Yeah, we also have those.
And how different are they? Overlap is like 70%, 50%, 90%, or can you say a word?
The signal is less precise, less accurate. I think if I reshare the screen, I have something at the bottom of the slide. But the signal is less accurate, but the message is the same. So it's signal crisis in the same periods. For the global financial crisis is where there is some divergence for some reason.
I see, because nobody expected it, sort of. Okay.
Not for the debt crisis, which is at the very beginning of the sample. For the tequila crisis, essentially the same signal.
Thanks.
So I don't see any other questions or raised hands right now. Last chances. All right, so if there's no more need for discussion, I would like to thank all the participants, in particular, of course, the presenters and the discussants. Everybody did a fantastic job in this still probably unusual setting, although we are getting better at all of this. But thank you so much, and I don't know, maybe we give everybody a hand, or I don't know how we're going to do it.